interest costs are going to continue to go up for the federal government unless bonds rally significantly and interest rates drop significantly. Interest rates are going to continue to go up for the federal government, so the deficit's only going to get worse. And this is what we call, and others have called it this as well, a doom loop. The government issues bonds. Those bonds being issued creates supply of bonds. There has to be demand. If there's not enough demand, or if there's a fixed amount of demand, all other things being equal, then they have to pay a higher interest rate. So the interest costs go up. They go up for the federal government. That makes the deficit bigger. They've got to issue more bonds. And as you can see, if that cycle continues without being interrupted, eventually there is no bond market. And we're not at that stage yet. But what I think is going on is that's starting to be widely recognized. You're seeing a lot of investors talk about it.
Welcome back to Soar Financially, everybody. Thank you so much for joining us. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter and the CEO of the Soar Financial Group. We have a fantastic conversation lined up for you again today because we have Larry Lepard joining us. He's an investment manager over at Equity Management Associates, and we decided to sort of cut this discussion into half. The first part we're going to spend on the macro. How is the economy doing? What's the Fed up to? How is the US dollar doing? What else have we discussed, Larry? Bond yields. Lots and lots of stuff happening. GDP numbers just came out today, so lots on the macro side to discuss. So we'll really try to squeeze that in. But then we're going to talk mining sentiment and gold stocks and the gold price, of course, as well, because it is, of course, interlinked and quite puzzling. So I'm curious if Larry has any answers for us here, because I'm definitely looking for some. But before I switch over to my guest, hit that subscribe button. It helps us tremendously, bringing guests like Larry on the program. Thanks so much for doing that. Now, Larry, it's time to thank you for coming on the program. Good to see you again.
Hey, Kai, very nice to see you again. Great to talk with you. I always look forward to our conversations.
Yeah, it's turning into a quarterly tradition here. I like that.
Yeah, right.
A lot of things change actually on a daily basis, so it's always good to catch up. Let's start with the macro, as I threatened in the intro here.
You threatened, yeah.
Right.
I'll try not to drone on too much. I mean,
let's see if we can summarize it, right? Let me try
and get the crisp summary. So the crisp summary is we're in a global sovereign debt crisis, driven by the fact that the U.S. federal government spending is out of control, and that therefore people are slowly but surely losing confidence in the U.S. bonds, U.S. federal bonds. And that's reflected in the fact that the price of the 10-year has gone from, threes in the 3 range up to as high as 5.0. It's a little below that right now, but it's quite a big move in a short period of time. And all the shorter bonds have gone up as well. And what this has done is it's driven the U.S. Federal budget into a situation where we're spending almost $1 trillion a year on interest on our 33.5 trillion, or actually 33.6 now, trillion dollars of debt. And a lot of that debt is stacked up in the earlier years. And even with the interest rates where they are now, some of that debt is at older, lower interest rates. So that in my quarterly report, which is just out, and you can find it on my website, we show that interest costs are going to continue to go up for the federal government unless bonds rally significantly and interest rates drop significantly. Interest rates are going to continue to go up for the federal government, so the deficit's only going to get worse. And this is what we call, and others have called it this as well, a doom loop. The government issues bonds. Those bonds being issued create supply of bonds. There has to be demand. If there's not enough demand, or if there's a fixed amount of demand, all other things being equal, then they have to pay a higher interest rate. So the interest costs go up. They go up for the federal government. That makes the deficit bigger. They've got to issue more bonds. And as you can see, if that cycle continues without being interrupted, eventually there is no bond market. And we're not at that stage yet. But what I think is going on is that's starting to be widely recognized. You're seeing a lot of investors talk about it. You're seeing the Wall Street Journal talking about it. You're seeing mainstream financial pundits talk about it. Those of us in the sound money world have been talking about it for several years now, but I think it's kind of really becoming acute. And the evidence for that is also seen in the price of gold, which historically, when interest rates have gone from 25 basis points, 2 years ago to 525 today on Fed funds, historically that would have really hammered the price of gold. And at some points in time, it kind of did. But right now, the price of gold is in the high 1900s. and it's really just a spitting distance, maybe 5% away from an all-time high, which I think a closing breakout over 2070 would represent an all-time high. And so that should not be happening, all other things being equal. I mean, real interest rates have gone up a lot, yet the price of gold has gone up. And what I think is going on is gold smells what's coming next, which is also outlined in my quarterly letter, which is that the Fed will have to, at some point, change their policy. Because if they continue along on this, as they've been doing, things are going to break and they're going to start to come unwound. And to some extent, things have already started to break. We saw it with Silicon Valley Bank in March, but they had a miniature version of QE where they, broke the Dodd-Frank law and injected money into the banks to keep them going, and they calmed everything down. But it's starting to get critical now, in my opinion, because the 5% rate on the 10-year is a meaningful number. And you're seeing it in a lot of other smaller measures, the U.S. Japanese yen rate, the 10-year yen cross, and the inflation swaps, et cetera. So that's the big picture macro. And to me, that's the elephant in the room, that the U.S. bond market's in trouble. And people are beginning to doubt, the ability of the Fed to continue what they're doing. And when they shift, they will have to start printing money again. And when that happens, inflation will get worse. And we'll get into a complete cycle of ultimately what will be high inflation, and perhaps even carry to its end point, a failure of the dollar, certainly a failure of the dollar against gold, silver, and Bitcoin. The three things that I consider to be sound financial alternatives.
No, fantastic summary, Larry. And I just realized we will be airing this interview on Halloween night.
Oh, great!
So let's try not to make it too spooky, all right?
Yeah, right.
But back on topic, you called the bond market a bit of the canary in the coal mine in our previous conversation. Where do you see things like? It feels like it's starting to crack a little bit, but so far, like bond issuance and treasury bill issuances have been soaked up like there's no tomorrow. Right, and the economy
yes
seems
and no.
extremely...
I mean, if you look at the longer durations, and I look at the tails on the 10 and the 30-year, those auctions haven't gone incredibly well. The short stuff, yes, it gets soaked up because hey, 5% on a 1 month, 3 month, 6 month, 1 year bond. I mean, hell, if I had cash laying around, I'd do that too. I mean, they're going to pay you back the money. There's no doubt, and you don't have any duration risk when you're under a year, say, in maturity. So. And what you've got money coming out of the reverse repo facility, which was kind of always a parking lot for a lot of the excess money that got printed during COVID. And so what you're seeing is that's getting drawn down, and it has a little ways to go. And so that money is coming into the shorter end of the bond market and holding things together. But eventually, the bond market was inverted, and that's changing. I mean, now it's getting to the point. I mean, the 2 and the 10, we're heavily inverted, which is an indicator that we're going into a recession. Now we're about flat, I think, and it could go the other way. And that's usually a signal that things are really starting to get bad in the economy. So, it's a real problem. And the reason the Japanese yen is important is that, all of these foreign countries hold a lot of our treasury bonds, and they will start selling them to defend their own currencies. So, that too would push, U.S. bond rates higher and make the problem worse. And, the other thing that I think is just really important to understand is just, I think everybody, what's going on, the tragic stuff that's happening in the Ukraine and the Middle East, I mean, the response by Washington has just been, well, we'll send 50 billion here, we'll send 100 billion there. Well, they're just, I mean, okay, great, why not send $1 trillion? I mean, it's like, it's kind of play money to these people. And so, and I think the casualness with which they talk about spending this money and running, we're running a $2 trillion deficit in an economy that has full employment, right? I mean, that's never happened before. I mean, we've got, $2 trillion is roughly 7%, I think, of the total economy. It depends how you measure GDP. But, that's like, okay, fine. What happens if and when the economy rolls over? What happens if and when the stock market rolls over, like it appears to be doing right now? Historically, in 2000 and 2008, when we had those big downturns, the stock market lost 50% of its value, and the deficits blew out, between 6 and 12%. If that were to occur again, I mean, we would have a deficit of $3, $4, $5 trillion, and at some point, the world starts to say, hang on a second, the United States has become a banana republic. They are printing money to pay the interest on their debt. They're printing money to pay back the debt. And that's what leads to a loss of confidence in the US and in the currency. And the way it manifests itself is in the price of gold, silver, and Bitcoin. And they've all started to behave pretty well in spite of the fact that interest rates are still, quite high. And the Fed has even threatened to raise them again, although they backed off. It's very clear they won't raise them in November. But
yeah, I think I just looked at the Fed Watch tool as well. 99.1%
yeah, right.
for a
Yeah,
stay,
well,
and then
yeah.
0.9 actually is for a reduction in rates. So it's not even showing
interesting. Huh.
an increase
Yeah.
anymore on the Fed Watch tool, at least. So
Yeah.
I was checking that out. I do have to follow up with you on the bond yields and gold price discussion.
Sure.
Because bonds used to be also considered a safe haven asset. All right.
Absolutely.
But it seems like it's losing, and I think I'm paraphrasing you here, but there's a lack of trust in the system. Okay. Is that why bond yields are also shooting up? Because as you said, like there's usually that correlation between gold price and bond yields. Because at 5%, why would I buy a non-yielding hard asset that I actually have to store somewhere and pay money to actually own?
That's exactly correct. You've hit the nail right on the head. I mean, as Luke Roman says, for the first time since the 70s, U.S. federal debt has started to look like it's not a good bet. That inflation is going to continue, and trust me, as the reason I've talked about the fiscal stuff earlier is that they're linked. I mean, it's not, and I think this is what Jay Powell is kind of learning, and I think he's a lawyer who doesn't really fully understand markets and how they operate. The reason that we've got this problem is that the government spending is out of control. I mean, if we had a balanced budget, it would be a completely different thing. Do you know what I mean?
Yeah.
But we don't. And so, and in fact, arguably it's going the wrong way. And I think that's what the real problem is,
No,
So
it's interesting because the government printing money, and I want to throw the GDP growth discussion in here as well, because we just got numbers today as we're recording. 4.9% growth in GDP. I'm sorry, I'm blown away by that number. I really have a hard time believing
same reaction.
it. So, can you explain it a little bit? Like, where is that strength coming from?
I'll tell you my take on it. Nobody can explain it. We're all just groping around in the dark, right? My best reaction is as follows: that GDP that's supposed to be net of inflation. Okay, so and I think the inflation number they're using now, the deflator that they're using is in the threes. So which I don't think is right. I think the inflation numbers have been wrong for a long time. They've always been kind of cooked and understated. Shadow Stats and others have shown that. So I think what that is there was call it 8% growth or 9% growth, of which and then they subtract off, or call it 8, and then they subtract off the 3 of inflation, so they get to 5. But the rest was really just inflationary. In other words, I don't think the economy, in terms of units sold, cars, houses, healthcare services, whatever it might be, I don't think the economy actually really grew. So I think the numbers are kind of fake numbers. But it's easy. I mean, it's just so difficult. I mean, so many of the numbers are really, really wrong. I mean, there have been great guys who've done analysis and pointed this out. I mean, like they say, we have incredibly low unemployment, and given the way they measure it, we do. But, take a look at the people who are discouraged and have left the workforce. They don't count them anymore. They're not part of the unemployment rolls. They just, okay, fine. So you're not looking for a job, or you're discouraged. You're not unemployed. You're just somewhere in society. So, it's kind of to me, these numbers, you got to take them with a grain of salt. And, everything I observe in the economy, I don't think the economy is healthy or growing. In fact, I think it's shrinking. I mean, certainly on the housing side in the US, I know you're not in the US right now. On the housing side in the US, it's really punked to going down. And that's in large part because a ton of people here are trapped in a house that has a 3% mortgage. I mean, trapped in a nice way. But they can't move. They can't move up or move out because they don't want to lose that mortgage, because the 30-year mortgage rate's now 8%. And so that's putting a real damper on housing. So I don't think the economy is as healthy as they say. That's kind of how I view it.
Yeah, no, one thing I learned today, and I posted on Twitter about a house that wasn't sort of finished, or like a group of houses that I didn't see anybody working on for weeks. And I learned today, actually, that the houses actually haven't been sold yet. So that's That's an interesting one because they're now being pre-built, and
Right.
there's no buyer for it or for them, which is something I haven't seen in Germany in the last 10 years.
Well, there's that, and also in the United States, I think what you're going to see too is you're going to see a lot of these Airbnb houses come back on the market.
Mm.
I mean, there's a bigger than realized, segment of the U.S. housing market where people buying houses to Airbnb them,
Yeah.
and that's
Oh, I was exchanging notes with again, side note here, quick anecdotal side note, in Vancouver for a trip I was planning. I was reaching out to somebody who was renting a house, and I was like, hey, can you give me a deal? He's like, no, I got to pay my mortgage, buddy. Right?
really.
So I thought that
Yeah.
was interesting. It's like, no deal, no discounts, right?
Oh yeah, yeah,
So,
right. I mean, yeah, it's a very confusing time. But I think there are a couple of things that we can all see pretty clearly. And to me, until they change, I'm not going to change my investment stance, which is the U.S. federal government spending is out of control. And that leads to growing deficits, which leads to pressure in the bond market, which leads to eventually the Fed will be forced into some form of yield curve control because things will break in the same way that Silicon Valley Bank broke, which is, I mean, everyone thinks a 5% on the 10-year is bad. Well, what about a 6 or 7 and 8? I mean, the problem here, Kai, and I talked about this on another show recently, and I think it's important to understand. A lot of people who are, it depends on your age, and I've been doing this since early 80s, right? Like I got in the business in 81. So, 2008 to present is just an unreal period. It's not the way markets work. It's not normal. It's abnormal. And the reason it's abnormal is that we had ZIRP from 2008 to 2015, and then we stopped it, but then it came back in 18, 19, then we stopped it, and it came back in 2020, et cetera, et cetera. So we had all of this free money, 0% interest rates, which led to all kinds of malinvestments, all kinds of bubbles. It really created this quote unquote everything bubble. And that everything bubble peaked in December of 2021. And I remember it. Crypto was flying, everything was just, nutty, bubbly, and going up forever. And that to me is a peak that's going to last for decades, unless we have a crack up boom. And so coming off of that, the stock market really got hammered hard in 2022. And I talked to all my friends who were heavily invested in somewhere. Well, buy the dip, it'll come back. And you know what? So far, until recently, or until the summer in 2023, they looked right. But you don't have a bubble of that magnitude burst and just have a 20% correction. And it's like, okay, we got a new base, it's all over. No, when you have bubbles of that magnitude, they go down 50%, 80%. And that free money distortion created that bubble, and that bubble's got to unwind. And by unwind, I mean stocks have to go lower, bonds have to get sold. I mean, there was a bubble in bonds too, right? I mean, in March of 2020, the 10-year yield was 60 basis points. I mean, good God, I mean, it was incredibly.
German 10-year or 2-year was negative. So
yeah, right, exactly. You had all these European bonds that were negative, exactly. So the point is, that was March 2020 was peak deflation, peak bubble. Okay. And then, the stock market and other things held on until, December of 2021. Fine. But that bubble's over. That bubble's burst. I mean, we got to correct all of that. And that's and people who think we're going back to the old world, and so many people tend to invest in the rearview mirror. Like, well, we're going to go back to a deflationary world. Well, you got to own these magnificent seven. Well, the tech stocks are the only place to be. Who needs gold? Who needs silver? Who needs sound money? Et cetera, et cetera. People are missing, they're missing what's really going on, which is we are now in an inflationary world. I mean, it just was in the journal yesterday, the UAW just settled for a 25% increase in wages at Ford. And probably more importantly, they got back all their COLA adjustments. So, Ford cars are going to be costing more. And, that's the problem with inflation. Once everybody, the cost of everything goes up, then the people who are working say, hey, I got to get paid more. And it becomes a spiral like in the 70s. And it's very, very hard to stop it. So that's what I see coming.
Yeah, it's interesting observation because it's also a good segue to mining stocks and the mining markets because
Yeah,
we've
right.
seen a
Oh
lot of
boy.
Q3 numbers being published, and to talk about inflation, price inflation of all-in sustaining costs. 'Cause some of the big producers are producing between $1,200 and $1,400, 12 being on the low end here, right?
I was going to
So
say, sadly, I saw a schedule the other day that showed some people at 16, 17. I mean, yeah, no, look, obviously miners have inputs that they use to get gold and silver out of the ground, and there's been inflation in those inputs. And, you and I can both remember not that long ago when ASICs were 700, 800, 900, 1,000 was high, and now 1,000 is low. And well, there's some that are below that, but not many. Yeah, so to talk about, I mean, I think we're segueing into why are
yeah,
the miners performing so poorly, and they have.
exactly.
And it's been absolutely dreadful. And I run a fund that's full of miners, so there's nobody who knows it better than I do. I totally get it and understand. And I'll offer this as my way of explaining it. Okay. If you get on Bloomberg and they have consensus estimates, okay, and I'm sure they're polling a large number of people, investors throughout the world, and the consensus estimate for gold 5 years out is $1,750 an ounce. So if you do the math and you say, okay, if everyone thinks that in 5 years gold is going to be at $1,750 an ounce, and all of your ASICs are creeping up consistently, well, guess what? These companies aren't going to make any money in a few years, right? And therefore, people are pricing the stocks, saying, well, with those low gold prices and these increasing costs, this is a shitty business. I don't want to own it. And so, you know, what's the error in this? I mean, the error in this, in my view, is that there's no way in hell that gold's going to be 1750 in 5 years. I mean, gold's going to be 3,000 or 4,000 or 5,000 in 5 years. So, but that's why the stocks have been held back so much. And as you know, the stocks are high beta plays on the underlying price of the metal. So that, but amazingly, the metal is held up pretty well, and it's held up pretty well because of what we talked about earlier, and that is I think it can see around the corner. But sadly, I don't think the stocks are seeing around the corner. I think the stocks are, and people are saying, well, this has been a shitty area, and there's still what I call battered gold stock bull syndrome. I mean, it's been really hard for the last, I've been in this since '08. I mean, it's been incredibly hard to be a gold stock investor during this time frame. It's just been really, really hard.
Absolutely.
And I can't tell you how much investor fatigue there is with me, with my investors, with anybody who's in the gold area. And I was just at Beaver Creek. I was just at the Denver conferences. They were like funerals. I mean, there were people there, but it was all the hardcore gold people. There were no new faces. And frankly, most of what was going on out there, in my view, was the smart big companies were there to meet the cheap small companies that were running out of money so that they could figure out what they were going to buy, because they can actually buy. I mean, there are multiple instances of smaller companies where 20, 40, 50, $70 million have been invested to drill a resource and plan a mine, and they're selling for a third of that in terms of the market cap. So, if you're a big company, if you're a big mining company and you have capital, you have access to capital, you're much smarter to buy than to build. If you try to, if you go out to build, you're going to have to pay full retail. But if you buy one of these companies, you're buying a lot of somebody else's work at a discount. So, and I think that takeover wave is coming. But what really needs kind of to get all this going, because that's what people probably care about, is we got to get through this 2100, 2070, 2100 level, right? I mean, we touched 2019 way back in 2011. We've now bumped up against the 2050, 2070 level 3 times. There's a nice line drawn there. And as you know, with algos and the way the world works, we need a breakout. We need to go to 2100, 2200, and then we'll squirt up to 3000 quickly, come back and retest, and we'll be off to the races again. And I think that will happen when people start to get the joke that the Fed really can't do what they say they're going to do. The Fed has convinced the world, and I know this because if you go to Bloomberg and you look at the 5x5 swaps, 5x5 inflation swaps, which is a measure of what inflation will be in 5 years for the following 5 years. So you can bet, will it be higher than this number or lower than this number? Well, right now, quote unquote, that number is 2.65%. So people, investors in the world are betting that in 5 years, inflation will be 2.65%. My view is no way, bullshit. Inflation is going to be much higher. And so, the way that I invest, or the way that I think successful investors, make money in the market, is you find the divergent view. You find the consensus view that you believe is wrong based on your logic, and you bet against it. And so, what I think is going to happen is, eventually what I've described, the monetary debasement issue, and the federal debt doom loop issue, are going to force more and more people to go. And we're already seeing this, by the way. I mean, the central banks are buyers of gold. Well, here's another good data point. I mean, in China right now on the Shanghai Gold Exchange, gold's selling at $100 premium, right? I mean, what's that all about, to Western markets? I mean, what that tells you is that over there's serious demand for gold over and above, what the Western market price is. So, to me, we're really close. And as the U.S. stock market continues to fall, and as the U.S. bond market continues to underperform, and as people become more and more aware of the fiscal doom loop issue that I described earlier, I think the $300 trillion of capital that's in bonds and stocks, is going to say, I need inflation, and as inflation continues, and by the way, the war doesn't help, right? And oil prices go higher, gasoline prices go higher, and people say, hey, this inflation is a real problem. I think that 300 trillion is going to come chasing our stuff, and they're going to say, I need to have. I mean, if you look at most of Western portfolio managers today, what's your allocation to gold? The answer is zero. I mean, I think there are probably only 15 or 20% that have any allocation, and most of those, their allocation is 1 or 2%. That's going to change. That's got to change. As inflation becomes a persistent problem, and as it becomes incredibly clear that the U.S. government cannot control its spending and is losing a grip on the bond market, gold is going to take off on the next leg, and it's not going to look back. So that's my view.
Yeah. No, I appreciate that, Larry. I think really, really, really good insights, because again, a lot of factors weighing on the gold price and sentiment as well. You mentioned in the beginning a lot of factors that seemingly affect institutional investors, right? But less so retail. But retail's money also has completely dried up. Institutional has been gone for a long time, I think, since it feels like 2008. There hasn't been really any institutional money, or very little in comparison. But retail has also disappeared, because that sort of pushed the markets a bit higher in 2020, and then it sort of trickled out again. Why is retail so negative on our sector?
Oh gosh, I can't say. I mean, I think it's just the disappointment. I think it's just the disappointment of seeing things, go up and come back, and that we have not had a really good persistent bull market in gold stocks since the 2000 to 2011 period. I mean, we had a blip in 2016, a really good year. We gave it all back, or a lot, not all of it, a lot of it back. We kind of chopped around in 17, 18. We had a really nice run in 2019 and 2020. I mean, my fund went up 97% and 122% back to back. So it was 4x in 2 years. But to be fair, I've given half of that back. And this is the way, I mean, this is very standard for big macro turns in markets. I mean, let me give you an example. On the other side of this, in the 80s, when I started in this business, everyone knew you had to be in commodities. Everyone knew you had to be in bonds. You had to be in gold. Everyone knew you had to be in oil, because we just had the decade of the 70s, which was nothing but inflation. And anyone who wanted to buy bonds was a complete friggin' idiot. And if you wanted to buy stocks, you were an idiot as well. And, in 79, Business Week ran an article entitled "The Death of Equities," right? And, it took a long time to get out of that sentiment. I mean, there were guys who bought zeros on the 10-year or the 30-year bond who made literal fortunes as deflation started to take place post Volcker, and there were guys who made fortunes in the stock market, by buying stocks. I mean, I remember buying Microsoft at 14 times trailing when it was growing 40% a year, in 83. I mean, right? And yet software was a stupid area to invest in. It was hated. It was like, it's vaporware. I'm not going to buy that shit. Anyone can do that, right? So, you know, and as you know, that was the kickoff. 83-ish timeframe was the kickoff of one hell of a bull market that lasted from 83 to 2022 with some very interesting drops in the middle, 87, et cetera, et cetera. But the point is that, you know, when a big macro trend shifts in the beginning, I remember 83, 4, 5, I mean, it's choppy, you know, it's not straight up. But to me, this is a big macro trend shift. And, you know, look, gold is at 1970 or so. And, you know, at the bottom in 2015, it was at 1,000. You know, it took a long time in the 2017, 2018 area to get through 1365. You know, and it's obviously messing around with 2070 or so, and it's, you know, it's a pain in the ass. We got to get through this next level, but, you know, I know we will. You know, I remember back in 08, you know, wondering, will we ever get through 700 or 800? You know, we did, and we scored it up to 1900. So, you know, it's coming. I mean, you know, the math. I mean, I go back to this isn't some voodoo. This isn't some, you know, my guessing or putting my finger up and trying to judge the wind. I mean, the math is unrelenting, Kai. You know, just the math is very, very clear. Go to my quarterly report, look at the chart by Lynn Alden that shows you how, as the debt continues to grow, the monetary supply has to grow or the economy will collapse. And so, you know, the Fed right now is playing a game. They're trying to deceive people into thinking that they can return us back to the ex-ante conditions of low inflation and slow growth. But they can't. They're wrong. I'm willing to take the other side of that bet. They're completely wrong. And the reason they're wrong is they don't understand the math of the situation. And so, you know, we are all going to be rewarded in this area. Sadly, it's not happening as fast as any of us would like, and it's no fun getting kicked in the teeth in some of these gold stocks. But I ain't selling, you know, and
I ain't leaving.
You know, I mean, yeah, right. And so, and I'm pretty sure we're right. So, you know, the rewards will be here for us, but we gotta. It's a hard trade, but it's really the only trade we can make, in my view. I mean, what are you going to do? Buy Nvidia? I mean, you know. And there's so much evidence of it too. I mean, and I remember, this reminds me a little bit of the bursting 2000 bubble. You know, I mean, it's very similar. Some of the high flyers go first, and then the more solid companies come next. And, you know, remember peak to trough, the NASDAQ in 2000 went down 80 some odd percent, and the S&P went down 50%. And I laugh at these people who say this market could never go down that much, and I'm just like, you guys haven't studied history. I mean, this bubble was bigger than the 29 bubble in terms of debt, market cap to GDP. It was bigger. It's bigger than the 2000 bubble. I mean, you can't just erase that. I mean, the 0% interest rates created a bubble in everything. And, you know, the prior bubbles, the 08 bubble, the 2000 bubble, you could bail them out because you could take them to a higher level. The 2000 bubble burst, and they said, all right, let's drop rates. We'll get a housing bubble going. The housing bubble burst. They said, okay, let's bail out the banks and we'll take rates to zero. Let's get an everything bubble going. Well, they did. And everything, you know, we peaked in December of 2021 and it's over. Party's over. And guess what? Money's about to return to its rightful owners. And the rightful owners are the people who have sound assets, and sound assets are gold and silver, you know, and Bitcoin. And, you know, I would highly recommend all your listeners go and look at Luke Groman's feed and listen to him talking to Danny Moses. I think it's On the Tape is the name of the podcast, and let him just have him explain the same thing, because some of what I'm saying, I'm relying upon other analysts who've done more work on this than I. But listen to his explanation of what's going on here. And, you know, he says, Danny asked him, says, well, okay, fine. Let's say the U.S. federal government was going to reset it. You know, what would the gold price do? And Luke outlines it just at a very conservative basis. The gold price would have to go to $20,000 an ounce. That's how much money we printed. I mean, I say this in another podcast. If you look at, in 1971, you could actually look at the monetary base and divide it by the 261 million ounces that the United States claims to own. Maybe they do. and you came up with a $35 reference price. If you did that same calculation today, you'd need to have $80,000 an ounce on the price of gold. So, that's a long ways away from 1900, and goes to show you how good the paper suppression has been. And, one could argue that maybe they're not going to reset with gold, but if not, what? I mean, Bitcoin, I don't think Bitcoin's ready to handle the reset. And we know that most of the central banks have focused in on gold as the monetary standard, it's the base of the monetary universe. So I expect, and even if we don't go with that reset, I think just on we continue along, they somehow manage to keep this system together and keep kicking the can. I think we're going to end up with a, $3,000, $4,000, $5,000 gold price easily. And if that happens, all these mining stocks are worth between 2 and 10x what they're priced at today. So
you mentioned kicking the can down the road, and a thought popped up, and I wanted to ask it like the last 2 minutes here. But did the Fed buy themselves another 5 to 10 years by going to 5.5% or 5.25%? Is that because I feel like, and maybe personal thought is like, I'm starting to feel like I might end up in the loony bin in 5 years if the crash doesn't happen. Okay, because I've been looking at it as well since 2013. I was like, okay, where's this going? Like, we can't have free money. Like, it doesn't make sense.
Yeah, I've talked about this a lot, and I've thought about this a lot, and I've been wrong a lot. So what I say is just one guy's opinion, and I could be completely wrong on this. Okay, but it kind of feels to me, Kai, like they got a few more back and forth. They have a lot of tools, right? I mean, I thought when Silicon Valley blew up, all right, this will be it. But of course, they came out with the BTFP, and they stuffed that one back in the can. Everything's good. They got a lot of tools, and obviously trying to tighten like they did, slowed down the growth of M3 or M2, and so on and so forth. And I believe there will be a few more swings. But I was talking in another podcast with somebody else the other day, and basically, the swings are getting closer and closer together, like the contractions when a woman was giving birth, and the amount of money involved is getting bigger and bigger. And so it kind of feels to me like there are a few more swings back and forth, but working. I mean, in our favor. I mean, if gold is at 3,000 and the mining stocks are up a lot, that's all in our favor. And then maybe they'll try something else. But it feels to me like there are a few more swings. But I personally think, and people ask me, say, well, okay, fine. When does it all end? What's the end point of it all? Because I think I think we're unless we either balance our budget, raise taxes, do all the stuff that would make us responsible, or we do a monetary reset along the lines of what Luke Gromen talked about. I think that we're ultimately heading to total failure of the currency. And my timeline for that is kind of in the early 2030s. So, you got to be kind of patient, but, and that's based on a lot of things, based on the slope of the curve, based on studying other hyperinflations, based on looking at other fourth turnings. I think this fourth turning started in 2008, and they tend to run 20 to 30 years. So in theory, it could be 2038 before it's all over. But, and the other side is going to fight. I mean, the people who run the system are going to fight hard to keep the system together. We know that. They'll change the rules. They may tax people who hold gold and Bitcoin.
Billionaires.
They may force us to take all our IRAs and buy government bonds. I mean, they're gonna push back hard. They may say sound money people are anti-American because we're not supporting the war. Whatever it might be, they're going to push back hard. So we have to anticipate all of that. But in my opinion, we have the winning hand. And so, I'm not willing to fold a winning hand. I just, I'm going to sit here and watch it and try and stay solvent. I'm not going to get highly levered because, there are swings back and forth. I mean, March of 2020, it was no fun watching gold get slammed and silver get slammed. And I was actually margined on my silver. I had a lot of ounces at a depository. I borrowed against it. And I got a call from the depository. Said, you better send us a couple $100,000. We're going to liquidate you at $11. And I was like, okay, no, you're not. Here comes the money. That taught me a good lesson about leverage. And, I mean, as you'll recall, when Powell came out with the monetary, bazooka, so to speak, gold went up $100 2 days in a row. And, that if we get another market break, another discontinuous event where everything correlates to one, then that's what will happen again. And so, I think everybody has to be somewhat prepared for the fact that it is going to be very volatile. And there's a great chart that you can go to Myrmecan's website. I think you can find it, that Dan Oliver did on the volatility of gold in the Weimar experience. I mean, it can swing up and down a lot because the government will say things like, "Yeah, we got this all under control." People believe it, but it doesn't last. So
good stuff, scary stuff. Fitting to Halloween.
It is scary. I mean, it's sad. It's sad that I was saying this to somebody else the other day. It's really sad to me, that we have 12 people on the Federal Reserve Board setting the price of the most important thing in the economic system, which is the cost of money, and they're not doing a very good job of it. They're totally out of control. So it's either massive inflation or massive deflation. I mean, and by the way, nobody probably could do a good job of it. I mean, the right way to have it done is by the free market. I mean, the supply of savings should balance out against the demand for investment capital, and the interest rate is the price at which those two balance. I mean, that's the logical and intelligent classical economic way to do it, but that's not what the system is now set up to do, and that's why we're all experiencing so much, inflation and pain, and it's such a mess. But if we all bet on sound money, eventually we're gonna drain them, and they're not going to have a choice. But their currency will become worthless, and everything will be, the currencies that we use will have a sound underpinning of gold, silver, and then maybe someday oil and Bitcoin. But I don't think they're ready yet.
Fantastic, Larry. What wonderful discussion. I think we covered a lot of ground here.
Okay.
It was really, really insightful. Where can we find more of you? What's the domain of your website?
Well, as you know, some people know, I'm a big loudmouth on Twitter. I try not to express too much anger, except at the central banks. I'm really frustrated with what these guys have done, but it's just my name, Lawrence Lepard, on Twitter. And then I've been referring to my quarterly letter. We publish quarterly letters. They talk about our macro views and our the fund that we manage, and they're all on the website. The website is Equity Management Associates. It's we abbreviate it to EMA, the number 2.com, EMA2.com. If you go there, you can find these quarterly letters and print them out. You can also, for free, there's a place you can enter your name, and we'll never spam you, but you can get on a free distribution list. So whenever we publish a quarterly letter, you'll see it. And then we run a fund that buys gold and silver mining stocks. Our goal is to beat the GDXJ, which on up years we've done, and down years we don't, because we take more risk than the GDXJ. And the minimum for the fund is a $200,000 account, and we do accept new investors. We're not quite full yet. So that's kind of the background. And I'm happy to if people want to reach out and talk or have questions, I'm happy to try and do that as best I can. Sometimes I'm overwhelmed with calls, but in general, I've tried to be helpful to people who are looking at the space.
No, fantastic. This was really helpful, the conversation, just putting some context around what is happening, right? Because there's a lot of noise out there, and trying to weed through that is not always easy. So
there really is. And I don't have all the answers, but this is how I see it. I feel pretty strongly about it. And I'm 66. So I've got, and I've been a professional investor my entire life, and I've got a good educational background to support it. So I'm not just some crank, even though I may sound like one.
No, fantastic. Larry, really appreciate your time. And to Larry's tune, check out other podcasts as well. As he said, like build your knowledge base. Like, it's free out there. There's so much good content.
Yeah.
As you said, go follow Luke Groman, go to his podcast.
Yeah, Luke Groman. I mean, if you want my go-to macro analyst, and you want to really gain a deeper understanding of what's going on in the monetary system, the two absolute go-tos are Luke Groman and Lynn Alden. They're both on Twitter. They publish an enormous amount of stuff for free. They both have subscription, newsletters as well, which I take and I think are worth it. But even for free on Twitter, you can learn a ton just following them. So.
No, I'm looking forward to interviewing Lynn Alden in New Orleans next week. So.
Oh, good. You're going to see. Oh, that's right. Good. Yeah, she's great. I love Lynn.
Haven't interviewed her in person yet. So happy to have her back on the program.
Yeah, so
really
smart. Her new book, by the way, is highly recommended. It's called Broken Money, and it really just everything we just described and talked about walks you through it in a much more eloquent way than I've just expressed.
Yeah, should get it at the airport or so. Right? Probably. Yeah. I need to get that, actually. It's I've seen it floating around.
I got to tell you, it's one of the better books I've read in a long time.
Ronnie Stoeffler recommended it on Twitter as well, I saw. So.
Yeah, on macro. Yeah.
Fantastic. Larry, again, thank you so much for your time.
Thank you, Kai. Very nice to talk to you. I'm sorry I'm not going to be in New Orleans. We'd like to see you, but Anytime you want to chat, just ring me
Let's
up.
catch up around the year end and give a bit of an
Okay.
outlook as well. So that'd be
Okay,
great.
that sounds great. I look forward
Fantastic.
to that. Thanks.
Everybody else, thank you so much for tuning in. We've really enjoyed this conversation with Larry Lepard. If you did so as well, go follow him on his website. Go follow him on Twitter because, as he said, he puts out a lot of content there as well. And if you haven't done so, smash that subscribe button somewhere down here below. I don't know. They moved it. It used to be over in this corner, but it's somewhere here now, I think. We really appreciate that. It helps us bring guests like Larry on to the program more regularly. And, of course, other great guests of caliber as well. As you heard, we'll be interviewing Lynn Alden. Love to get Luke Roman on and many others in New Orleans, for example, next week as well. Meet me in New Orleans. If you haven't seen that yet, I'll be there next week for 4 or 5 days. And join us in Frankfurt at the DEUTSCHE GOLDMESSE. Thank you so much for tuning in. We'll be back with lots more.